Most beginners don't lose money because markets crash. They lose money because they start without a framework. They buy what's trending. They panic when it drops. They quit before compounding starts working. Today, I'll show you the safe beginner path to investing, a global framework that works in any country, any currency. Welcome back, or welcome for the first time. This is Grecia Capito, and this channel is about building real wealth the boring, disciplined way, with systems, not hype. If you're tired of predictions, fast money promises, and internet noise, you're in the right place. This is week 2 of the Global Wealth Foundation. Week 1 was mindset. Today we build the beginner investment framework. If you want the full step-by-step roadmap, subscribe so you don't miss the next lessons. And if you appreciate structured, calm investing education, leave a like. It tells the algorithm this content matters. Let's start with the most misunderstood word online: investing. Investing is not watching charts. It's not predicting next week. It's not reacting to news. Investing is ownership. When you invest, you buy a small piece of productive activity, a company, a fund, real estate, infrastructure. You become an owner, and owners think differently than gamblers. Gamblers ask, will this go up tomorrow? Owners ask, will this produce value over years? Are you trying to predict, or are you trying to own? Trading is short-term price speculation. Investing is long-term value ownership. Trading depends on timing. Investing depends on time. Can people make money trading? Yes. Can beginners build wealth trading? Statistically, rarely. Because trading requires speed, emotional control, constant monitoring, experience, risk tolerance. Investing requires patience, structure, consistency. One is performance-based, the other is system-based. Now this is critical. Volatility is price movement. Risk is permanent capital loss. They are not the same thing. If your investment drops 20% but recovers, that's volatility. If it collapses permanently because the business fails, that's risk. So what reduces risk? Diversification, time horizon, quality assets. What increases perceived risk? Short-term focus. If you don't need the money for 10 years, is a temporary drop really a threat? Here is a simple global rule. Money you need in less than 3 years should not be in volatile assets. Money you don't need for 5 to 10 plus years can be invested. Why? Because time absorbs volatility. The longer your horizon, the less short-term noise matters. A good beginner asset has 5 characteristics. Productive, it creates value. Diversified, not dependent on one outcome. Transparent, you understand what it holds. Low cost, fees don't eat returns. Long-term viable, not a trend. If you don't understand it, don't buy it. Complexity does not equal intelligence. Now this part is important because many beginners hear these words: productive, diversified, low cost, but they don't really understand what they mean in practice. So let's slow down for a moment. If you're new and you're thinking, okay, but what does that actually mean for me? Good, that's exactly what we're going to clarify right now. When I say an asset should be productive, I mean it should generate value over time. A productive asset creates cash flow, earnings, rent, dividends, or business growth. A company produces goods or services. Real estate generates rent. A fund holds businesses that generate profits. Now compare that to something speculative. An asset that only goes up if someone else is willing to pay more later. If an asset produces nothing, creates nothing, and depends only on hype, you are not investing, you are hoping. And hope is not a strategy. If you ignore productivity, you increase the risk of permanent capital loss. Diversification means your result does not depend on one company, one sector, or one country. If you buy one hot stock and it fails, your result collapses. If you own hundreds or thousands of companies across industries and regions, one failure doesn't destroy your portfolio. Diversification reduces concentration risk, and beginners often underestimate this. They think, but what if this one company becomes huge? Yes, maybe, but what if it doesn't? Ignoring diversification exposes you to unnecessary volatility and higher downside risk. Diversification doesn't eliminate risk, it controls it. If you don't understand what you own, you won't hold it when it drops. Transparency means you know what's inside, how it works, why it should grow long term. If you buy something complex just because it sounds intelligent, you create psychological risk. And psychological risk leads to panic selling. Complexity does not equal intelligence. In fact, simplicity is often more powerful because you can stick with it. If your investment dropped 25% tomorrow, could you calmly explain why you still own it? Fees are invisible but powerful. A 1% annual fee may not sound like much, but over 20 or 30 years, it can reduce your total return significantly. Compounding works both ways. Returns compound, but so do costs. If you ignore costs, you quietly transfer part of your wealth to the financial industry. Low-cost investing doesn't guarantee higher returns, but it removes a guaranteed drag. A good beginner asset should still make sense in 10 or 20 years, not because it's exciting now, not because it's trending on social media, but because it represents something structurally durable: global business activity, infrastructure, broad economic growth. Trends change, technology changes, news cycles change, but productive economic activity continues. If you invest in hype, you accept hype risk. If you invest in durable systems, you reduce uncertainty. So let's bring this together. If an asset is not productive, you risk speculation. If it's not diversified, you risk concentration. If it's not transparent, you risk panic. If it's not low cost, you lose returns silently. If it's not long-term viable, you depend on trends. This is why beginner investing should be simple, structured, and durable. Not exciting, not dramatic, just rational. There are 3 global beginner paths. Path 1, individual stocks, higher concentration, higher responsibility. Path 2, funds and ETFs, diversified exposure, lower stress, beginner-friendly. Path 3, real assets, real estate, physical businesses, productive property, for most beginners. Broad diversified funds are the simplest starting point, not because they're exciting, but because they reduce unnecessary risk. So here's the safe global path. Step 1, build emergency fund. Step 2, define time horizon. Step 3, choose diversified exposure. Step 4, automate monthly investing. Step 5, ignore short-term noise. That's it. No predictions, no constant changes, no stress. Let's recap. Investing is ownership. Time beats timing. Volatility is not the enemy. Panic is. And structure beats emotion. If you want the beginner global investing checklist, comment checklist. Next week we go deeper into diversification and ETFs. Thanks for watching. This is Grissia Capital, a place for calm, structured investing education. No hype, no predictions. Just systems that help you build ownership over time. If this video helped you think more clearly about investing, subscribe so you don't miss the next lessons in the Global Wealth Foundation series. Next week we'll go deeper into diversification, funds, and ETFs, and why they play such an important role in beginner portfolios. Until then, build ownership, think long-term, and ignore the noise. I'll see you in the next one.